Swayam Prabha. Digital India. Educated India.
Welcome back. So, we will now discuss that how banks in a modern monetary system in any economy, okay, play an important role in this transaction, and how bank also can create money supply or increase money supply, that we will discuss, right. So, before that, say bank. What is bank? Okay, bank is a financial institution, okay, which accept money through deposits with the contract that whenever, say I am going there to keep my money in their vault, okay. With bank is actually legally signing a contract with me, or like me, all of us, the customers of that bank. Whenever we will go to withdraw our money, they are legally bound to return back, okay. So, whenever, of course, whenever means not in the midnight, within the working hours of the bank, okay. So, whenever we will go to withdraw our money, they are legally, or they are telling us that they will return your money whenever you will come to withdraw your money, okay. So, in that way, bank is an organization which keep money or which collect money in terms of deposit from its customers, that is bank. Now, whenever bank is collecting some money through deposits, through me, you and other people, right, bank used to pay some rate of interest to us, that is called monetary rate of interest, okay, or nominal rate of interest, that is called nominal rate of interest, okay. There is another concept called real rate of interest, I am coming bank's operation, real rate of interest, that actually these two concepts came into the context, right. So, nominal rate of interest is basically the rate of interest which is on the basis of nominal money, okay. I am keeping my 100 rupee in the bank, and say after 1 year bank will give me rate of interest of 5%. So, 5 rupee bank will give me in addition of that 100 rupee what is my capital or what is my principal, okay. So, that rate of interest 5% what we are referring, that is called nominal rate of interest. But what is the real rate of interest? Real rate of interest we can think of, say I am lending say 1 kg of rice today to you, after 1 year say perhaps you will return me back 1 kg and 100 gram of rice. If that is the case, we can tell that real rate of interest is 10%. In the sense that rate of interest is defined on the basis of real commodity or in terms of kind, okay, that we can think of, that is real rate of interest. Now, how we can quantify or quantify or how we can get monetary equivalence of real rate of interest? So, definitely if price level changes from one period to another, okay, the 100 rupee whatever value is 100 rupee today, it may not have same valuation tomorrow, same purchasing power it may not have tomorrow. If price level increases, actually its purchasing power falls, if price level falls, its purchasing power increases, right. So, real rate of interest, if it is denoted by R is basically approximately equals to nominal rate of interest, say I, minus pi is the rate of inflation, okay. So, this is real rate of interest, this is nominal rate of interest, and this is rate of inflation, rate of inflation, okay. So, there is a relationship, real rate of interest is approximately equals to nominal rate of interest adjusted with the rate of inflation, okay. So, you can understand that monetary value of today's 100 rupee may not be no longer 100 rupee tomorrow, okay, its purchasing power may go down if rate of inflation is positive. Okay, so that is why this kind of actually its exact relationship is R equals to I minus pi by 1 plus pi adjusted by this 1 plus pi factor in the denominator. Anyway, so you need not bother, we can derive that, we can establish this relationship, but that is not the scope, that is not within the scope of this course. Okay, so you can roughly because inflation and consumer price index and or different types of price index we have discussed in that chapter, these two concepts of rate of interest are there, we missed that. So, that is why since it came in this context, so I am telling. So, you can roughly remember that this is the relationship, real rate of interest is approximately equals to nominal rate of interest minus rate of inflation. Okay. Anyway, so what I was telling, that bank is collecting money from us as deposit, right, and bank is paying rate of interest to us. So, how bank will give that extra money? Okay. So, actually when bank is collecting that money, no, bank is not keeping idle all that collected money in its vault. Okay. Yes, it is keeping some portion of that money in its vault, okay, and remaining portion it is lending, because lot of people go to take loan from the bank, education loan, housing loan, lot of car loan, lot of loans are there, no. So, people take the loan from the bank. So, through this loan or in terms of loan, actually bank is lending money to the customers who is looking for loan, and you will see that the rate at which bank is lending, that is little bit above than the rate at which bank is paying to us as the customer, as the deposit holders, right. So, that margin from there bank is getting some profit. Okay. So, that is the bank's operation, roughly bank's operation. Okay. So, anyway, so and how that bank can create money supply within an economy? Look, bank from its experience, first of all, whatever money it is collecting through deposit from the customers, right, it can't keep entirely in its vault, okay, to meet up whenever you are coming to for withdrawing your money, to meet up your demand, it is not keeping in its vault. So, it is roughly keeping a percentage of that, say maybe 10% of that it is keeping in its vault. Okay. Why 10%? Bank presume that it is sufficient to keep only 10% is enough, 10% or 5%, whatever it is, okay, some percentage of that. Okay. Because bank is confident that it is not the case that all the people will come one single day to withdraw all of their money. That is not usually happen in reality. Not only that, in every day to day business, although few people come to withdraw their money, few customer also come to deposit their money. So, bank from its own experience, they understand that although that some stipulated guidelines from central bank is also there, you have to keep minimum that many percentage, that is called CRR, cash reserve ratio, we are coming to that. Okay. There is a stipulated percentage or stipulated guidelines are there from the central bank. Central bank is basically in any country, there is a central bank, like in India it is called Reserve Bank of India. Okay. It regulate and monitor all the banking business houses, okay, the banks what is operating within that country, both public sector banks, private sector banks, foreign banks, whoever which is operating within that economy. There is a central bank in India like Reserve Bank of India, it is monitoring and controlling all the banks, right. So, Reserve Bank has certain stipulated guidelines that minimum that many percent bank has to keep in terms of cash in its vault, that is called cash reserve ratio, CRR. And in any case, that from the bank's experience, what I was telling, that it knows that only a fraction of the total collected deposit money it can keep idle at its vault to run day to day transaction activities, and remaining thing it is giving as loan to the loan seekers, okay, to earn income, interest income from the loan getters, right. Okay, and that from there it is getting some profit. Okay. So, look at here, suppose that that CRR is 10% or bank is keeping 10% as cash in its vault. Now, suppose I am depositing 100 rupee to the bank. So, what bank is keeping 10 rupee out of that in its vault, okay, and remaining 90 rupee it is giving as loan to the loan seekers. Okay. We are assuming that enough demand for loan is there, we are assuming if that is the case. Okay. Now, this 90 rupee, right, who is taking, right, they are using that 90 rupee to participate in some transaction, right, they are also purchasing goods and services or investment, they are investing, right, somewhere, right. That 90 rupee they are wherever they are spending, right, to whom they are putting, those people also can deposit that in the bank, not necessarily the same bank branch, maybe some other branch of the same bank, maybe some different bank also, but that money is coming back as deposit in the banking system to the entire banking system of that country. So, out of that 90 rupee, okay, that 90 rupee is going to the bank again, okay, and out of that 10% means 9 rupee bank is keeping in its vault as idle, and 81 rupee it is giving again as loan. So, in that way it is creating again and again the money supply. Now, look at here, until this level how many total money is created within the society? 100 rupee only, but that is performing 100 plus 90 plus 81, that many money. So, in that way bank can create, bank means not a single bank, the entire banking system of an economy of a country can create how much money supply? This is 100, okay. So, first it is 100 plus 100 whole into 1 minus r, that r is this 10%, okay. So, it is r is 10% means 0.1, so this is 0.9 plus then 100 whole into 1 minus r whole square, because that 1 minus r whole square, because this is in our 100, in our example this is basically 90, because r is 10%, r equals to 10%, okay. So, remaining thing is going, so 10% means 90% of 100 is 90 rupee. This is basically 100 into 1 minus r is 90 rupee, that into again 1 minus r, that is 81 rupee, plus in that way it is creating, okay, and it can go, we can think of an infinite series, okay. So, it basically if you take 100 it will be 1 plus 1 minus r plus 1 minus r square plus in that way, okay. Say 1 minus r is a fraction, 10%. So, 1 minus r is also a fraction. So, suppose 1 minus r I am terming as q. So, this is basically 100 whole into 1 plus q square plus q cube plus dot dot dot, it is an infinite series. So, this will land to 100 whole into 1 by 1 minus q. If you do this, okay, you will get that it will reduce to this thing 1 by 1 minus q. How you can see? You just multiply this third bracketed term with 1 minus q, we will see that you will landing with 1, okay. So, that is 1 minus q and q is 1 minus r. So, that means this implies 1 minus q is basically 1 minus 1 plus r. So, r. So, this is basically 100 whole into 1 by r. So, this factor 1 by r is the 10%, if the example we are taking r is the 10%. So, 1 by r you understand, okay, 10 times, right. So, 100 rupee can create 1000 rupees of credit within the society, okay, if this r is 10%, okay. So, that is the thing. So, banking system can generate money or can create. So, this 1 by r, this component is called credit creation multiplier. So, you can understand from where this name is coming, credit creation multiplier, okay. So, 100 rupee it is creating 100 into 1 by r amounts of credit within the society. That is why credit is created multiple amount of 100 rupee. So, that is the multiplier factor 1 by r. In this particular case, if r is 10%, it will be 10, r value is 1 by 10%, no, 1 by 10% means 1 by 0.1, so that will be 10. So, credit creation multiplier value will be 10. So, that is why I am telling 100 rupee can create 1000 rupees credit through this banking system, right. So, this is called credit creation multiplier. In any case, so banks in this way, in a modern economy, right, banks can create a lot of credit, okay, and in that way bank can create or generate money supply, increase money supply by this through its regular day to day business activities or transaction activities, okay. That is the thing. And in any economy, right, money supply, okay, certain components are there called M0, they are, those are denoted by M0, as those are called, say M0 is called narrow money, okay, then M1 and then M2 and M3. I think M3 is called broad money, and certain other components are there, broad money, okay, M2, no, M0, I am sorry, M0 is called reserve money, okay, this is called reserve money, this is called narrow money, and this is called M3 is called broad money. But what are the components of that M0, M1, M2 and M3? It is there in your book, okay. I also usually forget the different components and all, because that check transaction, okay, and then deposit also, different types of deposits are there, no, current account deposit, saving account deposit, then time deposit and so on, right. Time deposit, even time deposit with different kinds of maturity, maybe 1 year, maybe 5 years, maybe 10 years and so on, right. So, lot of things are there, other than these kinds of deposits, right, lot of different commercial papers are there, monetary instruments are there, like CD, this is called certificates of deposits, it is available in the bank, okay. This is some sort of commercial paper which has some monetary value, right. So, certificates of deposit and lot of these kinds of things are there in that monetary system, and what are their respective components and all, what is the definition of this M0, M1, M2, M3, those are there in your book, nothing as such to understand those components, but you have to learn those things. So, one advice is that whatever is there in your book, that is as per the Federal Reserve System, Federal Reserve System. Federal Reserve System is the central banking agency in the United States of America. Okay, lot of federal banks are there, say Federal Bank of, say maybe Kansas City, Federal Bank of some other city like that. So, those federal banks all together called Federal Reserve System, which is the central banking authority of United States. So, what I am advising that you, those definition of M0, M1, M2, M3 as per Federal Reserve System may be slightly different of those definition as per the Reserve Bank of India for our country. So, I am advising all of you to go through these components, okay, whatever is there in your book, but those portions will be replaced, should be replaced by the counterpart components collected by Reserve Bank of India's website. So, in India, the central banking authority is Reserve Bank of India. If you visit their website, okay, and look for what is the definition of M0, M1, M2, M3 or this reserve money, narrow money, broad money, all these things, and what are the components within each of those M0, M1, M2, M3 and all those things, you can easily get that, right. So, I am advising you should know all of these components. All of these components are components of money supply within a country, money supply within a country, money supply within a country. So, those components you will get in your book, but I am advising you please replace those components or their definition by whatever is there in the Reserve Bank of India's website. So, the components are there, note down here, it is a lot of components, I have to spend the time to note down them here before you, which I do not want to. All of you are advised to look into Reserve Bank of website for the definition of each of these components. and what are those? Like say reserve money is telling that currency in circulation means that currency notes and coins whatever is there under the circulation in the within the country, what is there with me, you, all the agents, all the people of that country and with the banking systems. Okay, those are called currency in circulation. Plus bankers deposit with the RBI plus other deposit with the RBI. So, for instance M0 which is called reserve money that is basically currency, this I am telling as per the Reserve Bank of India's definition, currency in circulation plus bankers deposit with the RBI means Reserve Bank of India plus other deposits with the RBI. Okay. So, these are the M0. Similarly, M1 equals to some M0 plus something else are there, something like that in that way. So, I don't want to discuss all of those things here to spend our time. Rather you look at those and what are each of those components that is there in the Reserve Bank of India, that is the good guidelines for you to study. Let me quickly finish some other concepts in this regard. Okay. So, bankers deposit with RBI is what? See, as we told, since we are discussing M0 in any case as per Reserve Bank of India. So, let us discuss. So, currency in circulation, what is that? We are defining. So, all those currencies if you combine together, okay, that is the currency in circulation. Okay, that means maybe in India today it may be say 500 crore amount of currency in circulation. So, that is this amount. Okay. Then bankers deposit, as we told, the Reserve Bank of India is the central bank of this country of India. So, this central bank is basically the act as a banker of different governments. Our central government, different state governments also across India is a federal country, no, so many different states are there, right. So, each of these states they may have their deposit or their some deposit account with the Reserve Bank of India, right. It is a banker of the governments also. Not only that, it is banker of the banking houses also. So, many banks are there, no, say public sector banks, say State Bank of India, Punjab National Bank, like those, no, Allahabad Bank, so many banks are there. Similarly, some private banks are there, say ICICI Bank, okay, then some others, HDFC Bank, okay, those kinds of some private banks are there. Similarly, some foreign banks are there, say Standard Chartered Bank, HSBC is basically I think Hong Kong and Shanghai Banking Corporation, its full name, right. It's a foreign bank. Okay. So, all these three categories of banks as per the ownership, like publicly owned banks, publicly means government owned banks, okay, and then privately owned banks and then foreign banks, right. All these banks to do engage into banking operation or banking business in India, they have to follow certain guidelines which are stipulated or mandated by the Reserve Bank of India. Okay, and in that process they have to have certain account also with the Reserve Bank of India. Okay, those accounts, that is called bankers deposit account with the RBI, Reserve Bank of India. So, how much total amount of money are there with those kinds of bankers deposits with the RBI? Those things also we should consider into account, because this is plus. Okay, and similarly other deposits with the RBI, these other deposits with the RBI mostly maybe government deposits, what I am telling, no, central government and different state governments or federal different states of the India, okay, they have their deposit account to the Reserve Bank. All those kinds of whatever money is there or how much money is deposited with the Reserve Bank of India through those accounts, their combination, all these three combination is called reserve money. That is one component of money supply in India. So, in this way you have to go through Reserve Bank of India for other three components, M1, M2 and M3. Okay, we are skipping that. Let me quickly quickly introduce here what is the how that supply of money can be controlled by Reserve Bank of India within a country. Like when inflation happens, what is inflation? Inflation means whatever real goods and services are there for transaction, available for transaction in real economy, right? More amount of money is actually rushing behind them. As a result, price level is increasing, right? Say suppose say 10 kg of rice is produced, right? And suppose say 400 rupee is enough for that 10 kg of rice to be transacted smoothly within the society, because per kg of rice price is maybe 40 rupee. Okay. Now suppose instead of 400 rupee, 800 rupee, are there people or potential customers who are coming to purchase that rice, they have 800 rupee in their pocket and they want to spend that for purchasing rice. What will happen? Definitely rice price will increase, right? Instead of 40 rupee per kg, perhaps it will go to 80 rupee per kg, right? So that is called inflation. Inflation is basically increasing the general price level, right? So indirectly I am interpreting that inflation in this way. More amount of money is rushing behind relatively less amount of real goods and services, right? So when inflation is there, that means money supply is more, that is why inflation is there. Central bank, in India it is Reserve Bank of India, they can take certain policies through which they can try to control money supply, to keep price level in some acceptable level. Price in some acceptable level, right? So what are those instruments? One is called bank rate. What is that bank rate? Bank rate is basically when different banks take loan from the Reserve Bank. Banks that bankers deposit with the Reserve Bank of India. In M0's component we have discussed in the last slide, this slide, bankers deposit with the Reserve Bank of India. So through that deposit account, banks can take loan from the Reserve Bank of India, or bank can deposit money to Reserve Bank of India. Okay. So when banks take loan from the Reserve Bank of India, at what is the rate of interest Reserve Bank of India charge, that is called bank rate. Now suppose why bank will take loan from Reserve Bank of India? Suppose okay, bank to keep 10% of that money in their vault. Now suddenly that today the demand for so many people came for withdraw their money, that amount of money whatever is stored in the Reserve Bank's respective bank's vault, that is not enough. So as an emergency, this bank can take some loan from the Reserve Bank of India, okay, to meet up this demand. Okay. So then they have to pay some rate of interest to the Reserve Bank, right? So that rate of interest is called bank rate. Now if Reserve Bank of India increase that bank rate, suppose earlier that bank rate was 10%, now it is 12%. So what will happen? So taking a loan for these banks to take loan from the RBI, that it will be more costly. The rate of interest they have to pay, earlier they were paying 10%, now it is 12%. Okay. So loan is more costly, becoming more costly to the banks, right? So then bank will try to take as less loan as possible from the Reserve Bank of India, because it is becoming more costly. Any costly thing we try to always purchase less, or okay. So that way, so as a result, they will take less loan, they will give less loan to the general people or loan seekers to the banks. Okay. So in that way, money supply can be curtailed within the society. So this is one instrument called bank rate. Okay. Bank rate in India, it has two components. One is called repo rate, another is called reverse repo rate. What is their respective definition? If any of you are interested, you can look at in the Reserve Bank of India's website, those definitions are there. So broadly, these things are called bank rate at which commercial banks take loan from the central bank. Okay. Okay. So through bank rate, Reserve Bank can, central bank can control money supply within a country. Similarly, CRR, that is called cash reserve ratio, as we told sometimes back, cash reserve ratio. I am collecting 1000 rupee as deposit. So Reserve Bank of India mandate is that for all the banks minimum 10% CRR they have to maintain. If that is the case, so out of 1000 rupee I have to mandatorily keep 100 rupee as cash in my vault, and up to 900 rupee I can keep more than that as cash in my vault, no issue, but minimum 10% I have to maintain. So, up to 900 rupee I can give loan to the customers or loan seekers, right. So, of course, this CRR is another instrument for the Reserve Bank of India to control money supply. How? See, when Reserve Bank of India or central bank wants to reduce the money supply, they can increase the CRR. So, suppose earlier CRR was 10%, now I am making 15%. So, banks are forced to keep more amount of money as cash idle in their vault. So, they can't lend that much money to the people. So, less amount of money will come to the people's hand, less amount of money will come to the under the circulation within the economy. Okay. So, price level will have a come down, we can expect to have a tendency to come down, right. So, CRR is cash reserve ratio is another instrument by the Reserve Bank of India or central bank by which using which it can control money supply within a economy. Similarly, third, SLR. It is SLR, it is called statutory liquidity ratio. What is that? All the banks, they have to they will invest, but their investments a certain percentage, maybe 20% or 30%, some stipulated amount is there. What is the SLR currently in India? That is there in Reserve Bank of India website. If you visit, you can see. I can't remember that. Okay, but what is the idea of SLR? SLR is that banks are forced to invest in certain government or RBI allowed stipulated commercial papers, specific commercial papers you have to invest there. So, when I am a bank, I collected a lot of money through deposits, but I am not that much flexible to lend those monies to anyone whom I wish. I have to keep CRR as cash in my vault. I have to deposit SLR proportion of my deposit to stipulated instrument as my investment, okay, and remaining thing I can give to loan seekers as I wish. Okay. So, again that SLR is another instrument through which central bank can control money supply within a society. Why? Because when I want less amount of money to be transacted, to be circulated under the people's hand, I will increase this SLR. So, whenever central bank wants to curtail the money supply within the society, to reduce the price level within the society, it can use all these instruments and it can increase all these instruments. And obviously, vice versa also is true. If central bank wants money supply to be increased within the society, it can reduce any of these components or all of those components or a combination of those components, right. Another is there, it is called open market operation. Open market operation. What is that? What I am telling through SLR, right? Banks are forced to invest a section of their investable resources in stipulated certain commercial papers as mandated by the central bank, right. Those commercial, so when I am purchasing those commercial papers, right, those commercial papers are with me, I am a bank, okay. So, when central bank wants that people needs to have less money in their hand in circulation within the society, then central bank will sell this kind of commercial paper to the banks. As a result, when banks will purchase those commercial papers, banks has to pay money to the central bank. As a result, bank will have, individual commercial banks will have less amount of investable resources or lendable resources in their hand. Okay. As a result, supply of money will be curtailed within the society, within the economy. Okay. That is the open market operation through which bank can intervene. So, these are the instruments using which a central bank can control money supply within an economy. Okay. Let me just two more concepts not related to this banking things as such, but one component is related. Usually in the business newspaper or common sense economics, you will frequently come across two terminology. One is called fiscal policy vis-a-vis monetary policy. So, when we are telling that central bank can use these so many instruments it has to utilize or to control money supply within an economy, those instruments or this policy when central bank is taking, those are called monetary policy. So, monetary policy is taken by the monetary authority of an economy, mostly the central bank. Okay. But what is the fiscal policy? Fiscal policy is the policy by the government. Like say we told that why our GDP has 5 components or 4 components, C plus I plus G plus X minus M, if you can remember. Okay, this G is the government spending, right, government consumption expenditure, right. So, this government spending, investment also may have a part of government investment, right. This how much government will invest in say maybe in education sector or health sector, like that different sector governments invest or government spend some money, right. So, how much they will invest, that decision usually taken by the government. Okay, government, central government or different state governments also, government decide how much they will spend in which head of their expenditure, right. So, those government decision or government spending are called altogether as a part of fiscal policy. So, fiscal policy is the policy related to government income expenditure kind of activities, and monetary policies are related to are part of the monetary authorities, mostly central banks instruments or policies through which it can try to control money supply within an economy. Okay. So, just as a part of this discussion, we are just introducing these two concepts. You should be having some understanding what is by fiscal policy what we refer, by monetary policy what we refer. So, these are all about what are the part of our syllabus. Okay. And as you understand that macroeconomics, we covered selectively certain important terminology and important concepts. With this we finished this course. I hope all of you will enjoy and take care.